Hi, guys, and welcome to my course. Um, I'm so glad that you've joined. You decided to take the course. This is a big step in the journey to becoming a property and casualty agent. And I am a licensed agent here within the state of Texas. And I've been licensed not very long in the state of Texas. I was also licensed in the state of Ohio. So I've been working in the space for a number. I want to think a number of years, and I've taken the course, the test, the state exam twice. So this material that we're about to cover today will give you an in-depth view, a real quick one too. I think that's the thing. If you're having to study for this state exam, this course will help you get through the material a lot faster. Okay, you can, I want to say speed through this. There are 8 modules. I will be on each module, and I will leave you my contact information at the end of each module. Just a little bit more about me. I know you don't really want to hear that, but some people do. I have taught. I taught middle school, high school. I taught for 5 years, so I do have a teaching background as well as an insurance background. And one day the light bulb came on, and it said, "Okay, fine. Why don't you go ahead and teach your own course?" So here I am. So, guys, this is to help you pass the test and to get the information a lot faster. Okay. So again, this is property and casualty insurance, and this is a study guide for the licensing exam. And I want to say I don't know what state you're in, but insurance, there's some things that are basic about insurance, okay? And what you're going to get are the basics, okay? So you may want to say, okay, what about my state? What about if I'm in Utah or if I'm in Arizona? What's different in those states? That I can't tell you, but I can tell you the basics in insurance, in the insurance industry. Okay, it's a huge industry, what a multi-billion-dollar industry. Pay wise, honestly, I went from making $25,000 a year to making over 100, just to put it out there. Okay, so yeah, you can make really good money in insurance, but it depends on the company you work for. It depends on how well you are, how good you are in sales, and how well you are in selling insurance and persuading people to make a move and take action. Okay, and I do offer sales training if you need that. We can do one-on-one. I could do a group coaching session for sales as well as insurance. I'll give you my name, my email, and my phone number here. I'll put it in the course, and if you want to contact me, feel free to contact me. Okay. What we're going to cover, what you're going to learn, guys, in this course, and what you'll be able to do after you take this course is pass the state exam. Okay. Yes, I said it, and I would feel amiss if you couldn't pass it after this exam. And if you don't pass it after this exam, let me know, what I can change and what I can do better so that you can, help people to pass. But I would say this information is very, very solid on what's going to be on the test. Okay. Okay, guys, in the course, we're going to go over general insurance. What is insurance? Why do people have insurance? The basics. We're going to talk about property insurance. We're going to talk about casualty insurance. We're going to talk about auto insurance. We're going to talk a little bit about wind and hail insurance. We're going to talk a little bit about flood insurance. We're going to talk about insurance regulations. And we're also going to talk about insurance terms. And for me, again, I have a teaching background. And I like to read books. I like to read books in my spare time. I like the written word. And to me, taking the state exam and learning to pass this test is all about words and terms. So if you get like an insurance dictionary and go through that and just learn the words and learn the terms, you're going to be 50% there because a lot of it is just words and terms. Okay. Guys, this material is copywritten. Don't let me see my material anywhere on the internet, please. Thank you. Just thought I'd throw that out there. Now, guys, here's the thing with insurance once again. In my mind, in my little bitty tiny pea brain, I think everybody can succeed. That's just me. I taught, like I said, middle school, elementary school, and we had kids in there and they would say, oh, well, they're slow. No, They may be slow learners, but they're smart kids and they can still learn. Okay. So even if you consider yourself, oh, well, I'm slow, I can't get it, I can't taste it, you can still learn this stuff. It's not, and I guess again, it's just me. It's not complicated. It's not brain surgery. It's not rocket science. It's basically just words and terms. And if you sit down and you study the words and terms, you should be able to pass this test. It's not that hard. Not that hard at all. Okay. And then let's say this: why do people buy insurance? You know, honestly, I just got off the phone with the client, and it was him. It was a guy and his wife, and they were purchasing auto insurance, and and they had let their policy lapse. I think it lapsed on the 8th of May, and then they're buying more insurance. 6 days later, the 14th today. So it's like, no, you don't want to lapse, and you don't want, and you have to have it. So here's the thing. Why do people buy insurance? They buy insurance for several reasons, but the main reason people buy insurance is because why? It's the law. It's the law. Basically, simply is the law. In most cases, it's the law. I know, again, I'm in the state of Texas, and if you don't have insurance, I've heard stories where, they'll take your car, impound your car, and all these kind of craziness. But I don't know if that's true or not, but that's what I've heard. And then, you have homeowners insurance. I don't think you have to have homeowners, but if you have a mortgage, yeah, you got to have homeowners insurance. If you have a loan on your car, you have to have auto insurance. So, and then renters insurance, I remember, a long time ago when you didn't have to have renters insurance, it was optional in an apartment. Now, a lot of apartment complexes even are requiring you to have renters insurance if you're in an apartment. So a lot of times people are calling you, or they're seeking out insurance agents because they have to have the insurance. So it's not at that point, in my mind, it's not a hard sell, because I've had some products, I've never sold encyclopedias, thank you. But I've sold some products in the past that were pretty hard sells. And insurance is not one of those things. You have to have it. Explain to them, these are your coverages and this is what it's going to do for you. And, if they like you, people buy from people they like, and if they like you, most times they won't buy from you. Okay. Okay, guys, give me a second. I'm just going to rearrange here just a little bit. Okay, we're going to look at what? General insurance. And there are basic concepts when it comes to insurance. I mean, insurance of all kinds. And there are all kinds of insurance. And what are they? Risk. These are terms again. So write these down, guys. Take notes, okay? Don't just sit there and watch the video and zone out, take notes. You spent a lot of money on this course. I want you to take notes, okay? These are some basic terms that are going to be on the test. Risk, peril, and hazards. What's a risk? What's a peril? What's a hazard? You need to know these things in order to pass this test, okay? And when you talk about risk, there are two types of risk, okay? There's something called speculative risk, and there's something called pure risk. And in order to pass this test, you're going to need to know the difference between those two things, okay? Speculative risk, it entails a chance for loss and gain. That's like the stock market. When I go online and I buy some stocks, or I buy some Bitcoin or some Dogecoin, it's a speculative risk because you don't know what's going to happen. You don't know if the stock is going to go up. You don't know if it's going to go down. You don't know if it's going to go sideways. You can make money. You can lose money. Okay. So speculative risk is a type of risk you take, and you can gain or you can lose. Speculative risk. And then the other one here is pure risk. What is pure risk? Pure risk is a chance for loss with no possibility of gain. That would be insurance, okay? So insurance is pure risk with a chance for loss and no possibility of gain. Let me explain. An example. Let's say you're driving your car, somebody hits your vehicle, boom, now you're out of some money. Why? Because you may take off work too, right? So you can lose money from work. Your car is damaged. and now you got to get your car fixed. So what do? You call your insurance company and you say, hey, I just got into a wreck. It wasn't my fault. The guy hit me from the behind or whatever. But here's the thing. The insurance company is not going to pay you more than what the accident is worth or more than what your loss is. I remember I got into an accident one time and I wasn't in the car. The car was parked, which is kind of crazy, right? It was parked in the parking space. I was at work and it was icy that day here in Dallas. And somebody came into the parking spaces and they hit one car and all the cars hit each other, right? Which is crazy. But I had to go get my car fixed and it cost $2,500. It was a long, long time ago. So I don't remember the particulars on the incident, but I do remember my insurance company wasn't going to pay out any more than that $2,500. So it wasn't like, oh, I need $35,000 to go buy a new car. No, they're not going to do that. They're going to give you just what you've lost. Okay. So for insurance, you're looking at pure risk. They're only going to give you what you've lost and get you back to that place that you were before the accident. Okay, so let's talk a little bit more about perils and hazards. Okay, so if you look at peril, what is a peril, guys? A peril is risk. Is risk from a situation that increases your potential for loss. Okay, so let's say peril. Driving a car is a peril, right? Flying on a plane is a peril. I'm about to take a trip here pretty soon and haven't been on a plane maybe in a while, probably, I don't know, about a year or so now. And I want to think I'm a little anxious almost even, but it's a situation where you can lose, a situation where you can have loss. A peril. A peril would be if you're hiking on a mountain. You could fall off the mountain and boom, you can hit your head and there's a risk involved. Okay, so a peril is risk evolved from a situation that increases the potential or you can have loss. So that's a peril. Okay, what's perils? Perils are lightning, fire, wind, storm, water, ice. Those are perils. Those are things that can, if it's lightning, boom, you get struck by lightning, your car gets struck by lightning, that could cause loss. Fire. Let's say California, they have this all the time. They have fires, they have wildfires. And in those fires, you could lose your home, you could lose your life. That's a peril. That's a peril. That's cause of loss. Wind. In Texas, we have wind storms, where winds, we have tornadoes. That would be wind. And you can say, okay, it's windy outside and, the wind, brushed through and knocked something off my top of my house. That can be a peril. Okay, so I think you guys get the point. A peril is something that causes the cause for loss. Okay, what's a hazard? A hazard, and there are different kinds of hazards, as you can see there at the bottom. There's physical hazards, there's moral hazards, and there's a morale hazard. Like I say that right? Moral hazard. Okay, so a hazard accelerates the peril. Okay, so in insurance, a hazard means the condition or situations that are likely to increase the chances of loss. Okay, so let's say, for example, again, we're looking at a physical hazard. We're going to go into those more here coming up, but let's go to the next slide. Maybe it'll be on the next slide here. Okay, yeah. So let's look at physical hazard. A physical hazard is a condition in the environment that increases the chance for loss. Okay, again, a thunderstorm. Okay, you could be in a plane and it could be lightning, and the lightning hits the plane, or the wind knocks the plane out of the air or knocks off something on the plane. That's a physical hazard because there's something that hit the plane that caused the loss. Okay, and then there's something called moral hazard. A moral hazard is a little different. This is like when you engage in an act of fraud or dishonesty. That's a moral hazard. And a good example of that, I would say, I had a friend in insurance. He works with me as an agent, And she used to have a State Farm agency. And I can say this because it's kind of fresh on my mind, but there are all different kinds of ways to have fraud and dishonesty. But this one kind of sticks out for me as a good example. And she had a State Farm agency. She had her own agency, and some of her employees were writing checks, and they were writing checks to themselves. And they weren't supposed to be doing that. And that caused her company to get shut down. Okay. So that's considered a moral hazard. Okay. You have employees who are working for you and they're doing things that are dishonest or fraudulent. That's a moral hazard. So, kind of like when you make the choice to do the wrong thing. And we all are faced with that on a daily basis, right? And then you have something called a morale hazard. Okay. Morale hazard would be indifference to a standard of conduct or law is a morale hazard. Okay. We're not going to go into that anymore. Let's move on, guys. Elements of insurable risk. Okay. So what is insurable risk? Okay. So you can look at what the chance for loss. Again, the chance for loss must be spread among a large group of unrelated or unlike units. Okay. Insurable risk. Insurable risk can be defined and measurable. Okay. So what can we insure? That's the thing. That's the question now. It's like, okay, can we insure just any old thing? Maybe not. So when you're insuring a product or service, it has to be something that's measurable. Okay. So the risk must be able to be explicitly identify the loss and be able to calculate the loss. Okay. So you got to be able to measure the loss. Okay. So like a car, you know what the value of a car is, so you can measure that. It has to be predictable, right? The risk must be determinable through statistical data. Okay. Catastrophic risk. The loss may not be catastrophic, such as flood, earthquake, terrorist attack, or hurricanes, but you want to be able to measure the loss. Okay, and with that, guys, most insurance companies don't cover things like that. They don't cover flood, earthquakes, terrorist attacks, or hurricanes. And you're going to say, Ms. Brown, that's not true. They do cover that. Not so much. The national federal government does. Okay, so those are considered national disasters. When a flood hits, let's say a flood in New Orleans. Well, I can remember distinctly, and that's a long time ago. They had Hurricane Katrina in New Orleans, and that's a national disaster, right? So when stuff like that happens, they call in the federal government, because a lot of insurance companies, those risks are so large, and the loss is so large where an insurance company will go out of business if they had to cover those losses in a lot of times. So the company I work for now, I work for a company, I am licensed, and I'm not going to say the company name because it's not important, but in most insurance companies, they'll give you flood insurance. I think I had somebody here the other day. They had a home, and we wrote them "When in Hell" because they're in an area in Texas where they're in that zone where they could possibly be in the zone of a windstorm. So we'll write those policies, but they're kind of backed by the federal government. They're not our policies. They're kind of, our name is like a white label. Our name is stamped on it, but if something really happened, the federal government will come in and give the monies back to those people. Okay, so I don't want you guys to get that part confused. And I think I had it for a while where I didn't understand that. It's like, what? Yeah, the government covers that stuff. Okay, because they're just so big and so large where it would put a regular insurance company out of business. Okay. Insurable risk. What are elements of insurable risk? Financial hardship. Let's say the result of the loss should create a financial hardship or reduction in value. So let's say, again, you get in a car wreck, your car is hit, now you got this big giant dent in it. Mine cost $2,500 to get fixed. So now my car, if I go to sell it, I'm not going to get full value. I'm going to get less than because I got this big dent in it. Okay. So that's showing financial hardship. Okay. Let's say you're in, what's another one? I guess your house get damaged or something, and you go to sell it. You can't sell it at the same value because you got damage to it now. So you want to get your house back to where it was. The risk must be calculable. Okay. The loss must be calculated, and the cost of insuring the risk affordable. Okay. And that's where flood come in again. Nobody can afford to cover floods. So insurance usually covers things like, well, let's say renters insurance. Again, I sell a lot of renters insurance, and a lot of our policies minimums $15,000. That's not a lot of money to a big $1 billion insurance company. That's minor. The loss for personal loss on renters is minimum 100,000. That's not a lot of money to an insurance company. So the loss must be affordable. It must be something that the insurance company can actually afford to pay you back. On homes, we have losses. Like say you got a $500,000 house. If something happens, they have to come in and rebuild your home. That could cost the insurance company $500,000. They can afford that. Okay, they have that money to do that. So it has to be calculable. The risk does. Okay. Okay, guys, we're going to switch gears, so we're moving on. So write those down. And I guess the cool thing about having a recorded course is you can always go back and read it again. I grew up in an age where we sat in lecture halls and we took notes. And if you didn't get it, you just didn't get it. So you guys have it easy now where you can actually, watch the video over and over again until you get it. Okay. So watch it over again, but you need to know those things in order to pass this test. Okay. All right. Adverse selection. What is adverse selection? Adverse selection is a little tricky. Adverse selection is the opportunity of those whose risk is uninsurable to obtain insurance to the determinant of those who are insurable. Really tricky. Sometimes in the insurance industry, adverse selection refers to situations in which an insurance company extends insurance coverage to an applicant whose actual risk is substantially higher than the risk known by the insurance company. Okay. And I'm not going to get a whole lot into that. But I guess one way to try to explain it is some people, I guess they can't afford insurance. Let's say if you're in a poor area, maybe of town even, and you're living in a house and the house is old and, it's not really insurable. I've seen homes just like, nobody really wants to insure that house. It's like built in 1925, and the plumbing has never been replaced and the roof has never been replaced, So adverse selection is kind of like that. When an insurance company will insure, some insurance companies will insure those type of properties because they're also insuring homes that are higher value and that are more sustainable. So they may insure those other homes that are less desirable as well. Adverse selection. Let's go on to risk management techniques. Okay, guys. What are some risk management techniques in insurance? Okay, the way insurance manage risk is what? The way to manage your risk is what? Avoidance, which I love. I just try to avoid situations so that way there is no risk. There's reduction, there's retention, and there's something called sharing the risk. Okay, and insurance is sharing the risk. That's the answer. Ding, 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 ding. The answer is sharing the risk. Okay. But let's look at avoidance. And I use avoidance in my life because I don't drive a lot. I stay off the freeway. I just don't go to shady places. You know what I mean? So that would be considered avoidance. Okay. One way to manage your risk is to avoid certain situations. It's kind of like if you don't want to get fat, you don't eat the cake. You just kind of avoid it. That's what avoidance is. Risk avoidance involves staying away from activity that may increase the chance of loss, such as taking an Uber instead of driving yourself. That's another thing I love, is taking an Uber instead of driving myself. I drive, I have a car, I have insurance. I'm not talking about myself. I'm talking about my son now, okay? He's 19, and all the time I tell him, take an Uber. Why? Because you're not the driver. You have no risk at that point. My son does not have auto insurance. Why? Because he doesn't have a car. Okay, he can't afford a car. And I'm not buying him a car. How about that? Okay, but guys, get back on serious side. Um, Avoidance. I tell him all the time, take an Uber. Why? Because now you have no risk. You don't need auto insurance to take an Uber, and you don't have to worry about the risk involved because you're not in the driver's seat. When you put yourself in the back seat, your risk goes down. And that's one of the things I've learned in insurance, and that's one of the things I live by. Okay. Reduction. Risk reduction is taking action to reduce the potential for loss occurring. Okay, reduction, same thing. Um, Again, I would say, and I want to use the same example, riding your bike instead of driving, that's reduction. Taking the train, which is still dangerous, train could go off the track, but some people I know older people that take a train instead of getting on an airplane because they feel like they're reducing their risk. Okay. Okay, let's go to retention. Risk retention involves taking on some of the costs associated with taking on a loss. For example, choosing a large deductible. Okay, that's another thing I live by is retention. My insurance, I have a huge deductible. A lot of people, I talk to people all day. I talk to people all day, every day. I'm on the phone. Okay. Some people will tell you, they would jump through the phone and say, you know what? $500, take it or leave it. I got to have my deductible at $500. I got to have my deductible at $250. Okay, boo, calm down. I don't believe in that at all. My deductible is $2,000 on my insurance. Why? Because I'm retaining some of that risk. I'm retaining some of that cost. Okay. And here's the trick, guys. Once you get an insurance, you play with the numbers. Even on your own insurance, you play with the numbers. What you're going to find is that the higher your deductible, the lower your premium. Okay. So I live by that because my premium has to be paid every single month or every single year. So if I retain some of that cost and I get a higher deductible in case something happens, my premium is lower. Okay, so I live by that one. Here's what insurance is. Insurance is sharing. Risk sharing is the act of sharing the loss among a large group of people, i.e. insurance. And I got a typo there on large. I got 2 typos on this page. I got to go back and change. Sorry about that, guys. But I just saw those. So insurance is sharing. You're going to share the risk among a large group of people. Okay. So that's what insurance is. And that's going to be on the test. And you're going to need to know that. Okay. Thank me later. Okay. And one other risk management technique is transfer of risk. Okay. And I want to say insurance can be a little bit like transferring the risk as well. Risk transfer is the act of purchasing insurance in order to transfer the financial loss to the insurer. Okay. So you have a risk. I'm driving my car. And guess what, guys? My car costs $25,000 and I don't have $25,000. So if something happens to this car, I'm going to need some help. Okay. So because of that, I'm going to purchase insurance. So now if something happens, I'll have somebody to help me pay for that. That's risk transfer. Okay. Great job, guys. Take notes. And now we're going to move on to just that. The law of large numbers. That's what insurance is all about. Write that down. That's going to be on the test. Law of large numbers. You have to know this. The law of large numbers is a key concept for insurance companies. The larger the group, the closer the loss will be equal to is probability of occurring. Okay, so what that means is what insurance companies do is they sit down and they just run numbers all day. They have data, right? I was talking to a client the other day, and he said, well, why is my insurance so high? And I didn't want to tell him it's because you don't pay your bills on time, right? That's what I thought when I looked at it. But when you're in an insurance industry, there are lots of different factors that go into the data and goes into those numbers. Okay. As you know, you buy insurance yourself, right? So I told him, I said, well, there are a lot of factors that goes into that. They look at your zip code. They look at your car, the make and model of your car. They look at whether you're married or single. They look at how long you've had insurance. They look at a lot of factors. They do. But one of them is they look at whether you pay your bills on time. But the law of large numbers is that they look at a lot of data. They look at married people. They look at single people. And what they find is what? Married people drive better than single people. I don't know. Maybe single people got some issues going on there, right? And they look at boys and girls. Let's say girls are at 20 to 20 years old. Girls are better driver than boys at 20 years old, So they look at a large group of numbers, a large thing of data, and they say, okay, so we see over here, girls drive better. Over here, boys at that age, they don't drive very well. We see over here, married people drive better. We see over here that single people don't drive so well. And they take all that data and they come up with a rate for your insurance. Okay, so it's called the law of large numbers, and they do that with a large group of people. Okay, that's why they ask you all those questions. All insurances don't ask questions, but the really good companies, if your insurance company is not asking you questions, they're not a good insurance company, because a good insurance company will ask you a whole bunch of questions to get you to the right number on your policy. Okay, so let's look at that. Again, the law of large numbers, it is statistical anoxy. I'm not sure what word that is. I take that word out. It is a statistical matrix, I'm saying matrix, that states that the larger the number of exposure units independently exposed to a loss, the greater the probability that actual loss experience will equal expected loss experience. So I'm gonna have to change all of that, too many words. In other words, the credibility of data increases the size of the data pool under consideration. Again, the law of large numbers. Guys, that's going to be on the test. You have to understand that insurance, they take a lot of data to come up with your premium, and they take a lot of people to pay into that pool. It's like a big old pot, and everybody pays into the pot. And if something happens, boom, they take money out to help that person. Law of large numbers. Okay. Insurance. Insurance is risk transfer. We talked about that. So we're going to go into more detail a little bit. The contract is an aleatory contract where an unequal exchange of value exists between the owner of the policy in the form of a premium and the insurance company issuing a policy, which is the larger benefit. Okay, so what they're saying is it's an unequal exchange. Okay, so you pay a small amount in premium, and then the insurance company over here, they have a large amount where they say, if something happens, we're going to come in and we're going to pay you a large sum of money if something happens. Okay. It's also considered a contract of indemnity. What does that mean? That means they're going to restore a person back to their original value after suffering a loss, a pure risk loss. That's loss with no possibility for gain. Okay. All right, guys. I want to say we're wrapping it up here, but it doesn't look like we have a few more slides to go. So hang in there with me. I know it's a lot. It's been about 30 minutes. If you guys want to pause and take a break, you can do that. But I'm going to just keep it going here and try to get through this first module. And we've got 8 modules to go, and I'm going to try to get you through the next 7. Okay, so I'm one of those people where I get my gears going and I just keep going. Okay, so I'm going to keep going here. We do have a few more slides. So like I said, if you want to take a break, You can pause me and then come on back. Okay. So let's talk about insurable interest. Okay. This is a big one. I got a story. I'm gonna have a bunch of stories because it's better that way. I think people understand better, because I can sit here and read and tell you about all this stuff. You're like, what, huh? But if I tell you a story, I think people understand better. And let me know if my stories work or not. Okay. Insurable interest. My son, who was living with his father, he comes home and he says, Mom, I want to drive my stepmother's car, and I'm going to pay the car note, and I'm just going to drive her car all over town, and I'm going to get some insurance on her car. What you talking about, Willis? No, boo, you can't do that. Why? Because you don't have insurable interest in her car. You don't own the car. Okay. And I'm not sitting here saying, guys, that people don't do that, because I know people probably do, but it's not the law. It's not lawful. It's not the way to do things. It's not legal. That's the word we're looking for. It's not legal. That's illegal. You shouldn't be doing that. And insurance companies are not supposed to insure a vehicle you do not own. Okay. I own my car. It's registered in my name. I can buy insurance on my car. I had a customer, he didn't own the cars. And I said, look, bruh, I'm going to get you this insurance, but you got to get those cars registered in your name. Okay. So it'll be me and it's going to be you on the line. Okay. So that's my point. You have to own the vehicle. You have to have the vehicle listed in your name. And people are going to call you, and you thank me for this for later, but people are going to call you all day, all night, and they are not going to own the vehicle. Oh, I'm just borrowing the car. I had somebody come the other day. I'm just borrowing the car for a couple of months from my cousin now. No, boo. I can't write that. You have to own the car, like right now. And if you don't, go get it registered and come back, and then I'll write the policy. Okay. But be careful with that. Always ask people, do you own the vehicle? Is it registered in your name? And they'll tell you, because they don't know a lot of times. But if they say it's not registered in their name, don't write the policy. Save yourself some heartache. Okay. Insurable interest. In order to receive proceeds from an insurance claim, there must be something called insurable interest between the claimant, the person's claiming, and the property that suffered the loss. The insurable interest is a stake in the value of an entity or event for which a person or entity purchased an insurance policy to mitigate the risk of loss. I think I explained that really well. Insurable interest. Okay. Okay, so now we're going to talk about, this is going to be on the test, guys. I'm telling you ahead of time because I've seen the test a couple times, and this is going to be on the test. You have to know the types of insurers. You have stock companies, you have mutual companies, and you have reciprocal companies. What are they? Write this down. Stock companies are publicly traded and owned by shareholders. Mutual companies, there are no shareholders. The company is owned by its policyholders who receive dividends, kind of like a stock at that point, okay? Dividends represent the unearned portion of their premiums paid. Mutual companies, there are no shareholders. Reciprocal companies established by a group of members known as subscribers who pay a premium. That's what I have. I have a company that's a reciprocal company because I pay them a premium for my insurance. Okay, Lloyd's of London. Lloyd's of London, you should know this stuff, specializes in unique risk. Okay, let's say I'm LeBron James and I've got this great basketball arm or these great basketball legs or something, and I want to insure my body because, hey, this is how I make my money. Lloyd's of London insures specialized risk. They may insure LeBron James arms. I don't know, but they insure things that are specialized. Okay. Fraternal benefit societies, a non-profit association. The benefits are only for their members. It's a fraternal organization. And you've heard of these before. You probably didn't know this, but kind of like lodges or religious groups or charitable groups. They create their own insurance. People in the organization pay into the pot. If something happens, they can pay the member in the event of a loss. Okay. Risk retention groups. The risk is spread among the members who are responsible for their share of a potential loss, risk retention. Okay, again, we're going to move on. We're going to talk a little bit more about Lloyd's of London. Like I said, they're international, they're worldwide. I think they are in London. They're probably one of the original insurers, right? And they do insure specialized risk. Again, ball players, baseball players. You might have, great baseball legs or something. You want to keep those insured in case something happens. You get hurt, you blow your knee out. Okay, can I get paid $2 million because I can't play ball anymore? Okay, Lloyd's of London. An internationally acknowledged market of insurers, Lloyd's of London has been a major force in the U.S. insurance market for over a century. Throughout the long relationship, Lloyd's underwriters have continuously provided American businesses with creative solutions for their risk management needs. So Lloyd's of London is like the big boys, the whales, if you will. Let's say if you might have insurance on your house. Like I said, a basic insurance company can insure you for what, $500,000. I don't even know if we go over $1 million in some cases. But let's say you've got these mansions out there. I've seen homes in Texas, okay, that are $2 million, $3 million homes. I've seen $5 million homes, right? Who's going to insure those homes? Probably Lloyd's of London. Okay, I'm just saying. So they're for specialized risk, or for risk that a normal company may not be able to cover. Okay, and then there's something called domicile of the insurance company. Okay, domicile. What does domicile mean? That means, where does the insurance company originate? Okay, again, I'm located in the state of Texas, and I'm in the city of Dallas. So that's where I domicile. That's where I live. That's where I originate. Okay. So insurance companies have the same thing. They have a place where they originated. So they have different types of insurance companies. They have domestic, they have foreign, and they have alien. This is going to be on the test. You're going to need to know this. A domestic insurance company is headquartered in the state they're located in. For example, let's say Progressive. I don't know for sure, but Progressive is in Ohio. I lived in Ohio, lived in Cleveland, from Cleveland, Ohio. And Progressive is in Richland or Richfield, Ohio, someplace. And I think that's where they originated. I don't know, but I think so. I think they came out of Ohio and then they spread maybe across the country or something. I don't know. But what I'm saying is that that's where their headquarters, and that's the state they're in. So they're domiciled, they're domestic. So if I got insurance in Ohio and I got it from Progressive, that would be considered a domestic company if they're headquartered in that state. Okay. Foreign company. A foreign company is one that is headquartered in a different state in which it's located in. Okay. So let's use Progressive again as an example, only because I just did. Let's say Progressive is headquartered in Ohio, but I'm buying insurance from Progressive in Utah. Okay. So now I'm buying insurance from a foreign company. It's not headquartered in Utah, although they have a little office there, or they have a national line where I can call from Utah, and they offer insurance in Utah, but they're headquartered in Ohio. Okay. Alien. What is an alien insurance company? An alien company is an insurance company that is headquartered in another country in which it is located. Okay, so I want to say Lloyd's would be under that definition, right? Because I think Lloyd's is headquartered in London, but they can sell insurance in the United States. So they would be considered an alien company at that point. That's going to be on the test. You're going to need to know that. Write that down. Okay, guys, I'm almost at my hour. I think that was my limit. So I might take a pause here at the hour. But it looks like I got a few more slides here. But it looks like we may be able to finish here in the next 15 minutes. Okay, let's try to get this done. Okay. And then you've got 7 more and you're good. You're good to go. Go take the test. I seriously want to know if you passed and if this helped. So email me, call me, let me know, because I want to know what the results are. Okay. All right. And I'm rooting for you 100%. Okay. So let's talk about admitted versus non admitted companies. Okay. An admitted insurance company has been issued a certificate of authority by the state. Okay. So again, let's go with Progressive in Ohio. They're an admitted company because they have been given a certificate of authority by the state of Ohio to sell insurance in that state. Okay. And is authorized to conduct business in that state. So now they said, okay, they hung up their shackle. We're going to sell insurance. Our company name is Progressive. They go to the state. They give them a certificate of authority. You can now sell insurance in the state of Ohio. That's an admitted company. Okay. A non-admitted company is an insurer which is not authorized to transact business in the state, and the insurer may work with a surplus lines broker. Okay, got a typo in there. I see that. I need to go back and change that. So a non-admitted company, an example would be, I am Joe Blow Insurance Company in Texas, and I don't have a license, but I'm working with this other insurance company. Let's call it the General, because my brain couldn't think of nothing else. And they're working with the General, and the General is who are they getting their insurance from. So they're really not the insurer. The General is the insurer. Okay, so that would be a non-admitted company. Joe Blow Insurance does not have a license, does not have anything. They're working under the guides of the General, so they're not really admitted at all for the state. They don't have the certificate. Okay, and let's talk a little bit about surplus lines brokers. Okay, a surplus lines broker is a producer who is licensed and permitted to work on behalf of a non-admitted insurance company. Okay, surplus lines may provide coverage that is unobtainable through a traditional carrier, for example, Lloyd's of London. Okay, so there you go. A surplus lines broker is Joe Blow Insurance, who doesn't have a license to, or a certificate, but they're working through Lloyd's of London, or they're getting insurance from Lloyd's of London because they don't have the admitted certificate of authority that they need. So they're getting that insurance from someplace else who does have a license and admitted, and they are admitted. Okay. I hope that makes sense. That's confusing. Let's look at who you will become. Okay. Right now, I'm considered a producer. I produce insurance. I write insurance. I write over maybe 50 policies a month, which is a lot considering where I'm at. I'm an agent. I write auto. I write home. But I'm not a broker. I'm not a broker. What is a broker? Broker is different from an agent. Okay. So in your career, you can be a producer, you could be an agent, you could be a broker. It's up to you, which path you take. So it says these are individuals who work with an insurance company to transact business. Exclusive or captive agents. I am an exclusive. I am a captive agent. Why? Because I work with an insurance company and I don't work for anybody else. I work for one company. Okay. So an insurance agent who is contracted directly to the insurer and represents or sells insurance for one insurance company is an exclusive or captive agent. This will be on the test. You're going to need to know this. Okay. What is an independent agent or broker? I'm not independent. I'm not a broker. These individuals may represent one or more insurance companies, and another typo, I see that, and represent the interests of the insured and not the insurance company. Okay, so a broker. We all know what a broker is, right? Some people don't. So let's say you call me, ring, hi, my name is Carmen, and how can I help you today, right? Oh, I need auto insurance. You need auto insurance? Okay, got it. Well, let me check all of these different insurance companies and see who can give you the best rate. Okay. I'm going to check Progressive. I'm going to check the General. I'm going to check Geico. I'm going to check the Lizard. A Lizard is Geico. I'm going to check, who else? I'm trying to think of another company. I'm going to check a bunch of different companies, State Farm, and I'm going to see who's going to give you the best rate, and I'm going to let you know that company's going to give you the best rate. That would be a broker. A broker checks all the companies and then gives the insurer the best rate. Okay, so you're going to need to know that. That's going to be on the test. Okay, all right, guys, yay! Congratulations, you made it to the end of Module 1. We're almost at the end. Okay, and I made it to the end of Module 1. How about that? Law of agency. What is that? The law of agency means that the agent acts on behalf of the insurance company. Okay, an example. When I create a policy, an auto policy, I'm doing that on behalf of the company I work for. I have been given the I wouldn't say it's not explicit authority. They've given me that and said, hey, we're hiring you. We're going to pay you this amount of money, and this is what we want you to do. So they have given me that authority to write those policies, and I'm working underneath their guise. Okay, so I have law of agency. So that means that I work on behalf of the insurance company. When I put my name on a policy, that's the same as the company putting their name on the policy. They're backing me up. They got my back. Okay. Who is the principal? The chief responsibility of the producer is to collect premiums. Okay. So if you're an agent, if you're a producer, your job is to what? Collect premiums. That's what I do all day, every day. I collect premiums. I make money. I make money for the company. Okay, so that's what you're going to be doing. If you're going to be an agent, your job is to make money for the company. Then they pay you a portion of that money or however you get paid. Okay, law of agency. You work on behalf of the company. Types of authority. Like I said, there's expressed authority, there's implied authority, and there is apparent authority. Okay, and you're going to need to know this is going to be on the test, guys. Expressed authority is authority given in writing by the insurance company to the agent. Okay. Implied authority is authority assumed by the public that an agent can take an application and collect premiums. I have implied authority. Why? Because people call to say, hey, I got to get some auto insurance today. Can you help me? Yes, I can help you. But technically, it's not me. It's the company. Because if something happens, if they get an accident, they're not going to call me. They're going to call the company. They're going to call claims for the company. They're not going to call me. So I'm working, I have an implied authority to work or to take an application and collect premiums on behalf of the company. Apparent authority. Apparent authority, this type of authority exceeds what is given to an agent by their actions. Okay. This type of authority is not permitted. Okay. An example would be an agent accepting monies and depositing the cash into their personal bank account. That's apparent authority. I want to think that's a no-no. You know, like I said, my friend had the State Farm agency, and you had people writing checks, you know, putting them in their own bank account. That's a little illegal. You don't do that. Okay, so that would be apparent authority, and it's not permitted. You know, if you're collecting money for insurance, that money has to go toward the insurance, to the insurance company. That would be the proper thing to do. Okay, but these three things may be on the test, and those are three things you guys want to know. Okay, don't skip over that. Okay, yay! We're at the end, module 1. Okay, so guys, knowledge check. Okay, I don't have quizzes set up yet on this course. I need to get some set up, but I'm not a big quizzy person. I believe and I've taken a lot of tests. I have a bachelor's degree, and I've taken a couple of master's courses, and I've taken the state exam for life insurance. I've taken a state exam for property and casualty insurance. I've taken a lot of tests. and I'm not a test. I'm good at taking tests. I don't like them. I do it because I have to, and I don't want to put other people in that thing because I think it's awful to take tests. Okay, but I do need to set up some quizzes on here, and I haven't. So because of that, we're just going to go with the knowledge check. And the knowledge check is, what is pure risk? Okay. So I want you to ask yourself that question. Okay. This is open book test. Ask yourself that question. What is pure risk? Write down that question, write down that answer, or email it to me. Let me know what you come up with. Okay. But you're going to need to know that for the test. What is speculative risk? Write it down, email me the answer. Okay. What is the law of large numbers and what does that mean? Write that down. Write it. And I think that's the beauty of not taking a test. Write it down. Tell me what you think it means in your mind. What does it mean in the book? What does it mean for insurance? What is the law of large numbers? We talked about that in this course. So let me know what that means to you because you're going to need to know that on the test. What is a peril and what is a hazard? Okay. Write those two things down. Those are very important in the law of insurance, in the land of insurance, and you're going to need to know those two things. Okay. So if you write these things down, if you write down the definitions, if you study them, get yourself a insurance dictionary. I have one. I don't have it handy, but I do have an insurance dictionary where I can look up terms and words. Insurance is a huge industry, and you need to know the definition of these words. Okay. All right, guys, that's going to do it for me. And we did really good. We did it at the 56. And I don't have my information on here on this slide. I'll put it on module 2. And again, my name is Carmen. My phone number is, let me give you guys my phone number. I just changed my phone number here. Hold on. I'll give you a phone number. Cross your fingers. Hope I have it down here somewhere. Give me a second. Okay, I have a phone number. If you need to call me, my phone number is 904 is the area code, and my number is 526-6905. Okay, that's my phone number. And a good email address for me, I'll put it in the next slide, would be Magic Diva. Okay, and I spell it MAGIK. I think that's how I spell it. MAGIK, Magic Diva. Okay, yeah, MIGIKDVA @gmail.com. That's my email address. So you can email me, you can call me, leave a message, your name, your phone number, question. Same thing with the email. Send your answers to the test via my email. And in the next slide, the next module, I'll put that information in the last slide. So that way you'll have it. Okay. It was oversight on this one. I wasn't thinking that I would even want to do that, but it's okay. So, and then guys, what we can also do is we can set up, if you want to email me, call me, is set up a group study. We can do one-on-one, coaching. So all those things are also available with the course. Okay. All right, guys, that's going to do it for me. And like I said, see you in module 2. And if you have any questions or concerns or comments, good or bad, feedback, go ahead and email that information over to me, and I will read all of your comments. And I look so forward to meeting you guys. All right. Thank you. Have a good day.